All right, ladies and gents, I want us to go through part A and part B of the required in this information. And I want to do them simultaneously. So the approach that we're going to take for this particular question is that we're going to look at each sub individually, and then we're going to deal with part A and part B at once for that particular sub. Yeah, so if we look at part A, it says prepare only non-current assets section of the consolidated statement of financial position. So consolidated, guys, so remember your non-current assets will include investments other than the ones that have been eliminated on consolidation. It will have goodwill. There will be some deferred tax. There will be some PPE, intangible assets, etc. All right, so they want us to prepare that whole section for the statement of consolidated financial position as at the 30th of June 2019. Comparatives are not required. And then at the same time, they've also asked for the consolidated statement of change in equity, also for the 30th of June 2019. And you are only required to present the changes in ownership reserve, NCI, as well as FCTR. Okay, for those of you who are level ones, obviously the FCTR is outside of scope for you, but you can do all the other sections. Okay, so in this particular video, I want to focus on Ben as a subsidiary, and then we'll deal with each of the other subs in separate videos. All right, so if we look at the information, again, guys, from an exam technique point of view, always start off by setting up your timelines. And we know that they've asked for this for the 30th of June 2019. Okay. And before you even start reading the information, it is worthwhile just to go brush up on the additional information that they give you. Because that's where all your accounting policies and all of that will be. Right, so if we look at the additional information, okay, so they've already said NCI, we've elected to measure NCI in its investments and subsidiaries at proportionate share, so not full value or fair value method, not the full goodwill method. Profit after tax is accrued evenly throughout the year. Okay, we use an appropriate pre-tax discount rate of 9.44%, and if there's a rate implicit in the lease, the rate implicit is 10.25%. All right, none of the companies have paid or declared any dividends throughout the year. Okay, we classify interest income as part of other income, which is cool. And then Joe recognized any difference between the amount by which investments are adjusted and their fair value of the consideration paid or received directly as a changes in ownership reserve in equity. Okay. All right, investments and subs are recorded at cost. That's cool. Okay, you can assume that it's probable that there will be taxable profit against which future taxable losses could be utilized. So that just means if there is any deferred tax arising in this particular question, you are able to raise the deferred tax asset, because we're saying that there will be future taxable profits against which we can use that benefit. All right. If we look at our financial instruments in line with IFRS 9, we then fair value those and we record those in a mark-to-market reserve. Accounting policy for PPE is in terms of the cost model. Okay, there's been no changes in the share capital. Okay, and then if we look at Ben, Rob, and Lou, are all acquisitions in accordance with IFRS 3. And then, of course, they give us then the tax rates and your CGT rates, and they ask you to ignore dividends withholdings tax, which is fine. The only additional thing that they give us, and we'll deal with this when we get to MLU, is that the Mozambican income and capital gain tax rate is 32%. Okay. So now that we have an understanding of what all the accounting policies are that we're dealing with in this particular question, let's then go work through the information of Ben. So Just One Energy, Joe's leading renewable energy solutions company listed on the JSE. It provides turnkey solar and wind energy solutions related to related products to its customers. And it acquired various smaller competitors in order to obtain innovative products and increase its market share. Okay, the consolidated financial statements of the Joe Group for the year ended 31st June 2019 are in process of being finalized. Okay, in the information obtained, the relevant information required to analyze the consolidated statements is provided below, and all companies have a 30th of June year end. Okay, so that's all just basic introductory information. Okay, So the first one is we acquired an investment in Better Electricity, now Ben, on the 1st of January 2009, and we know that we obtained 60,000 shares. Okay? And at that date, we had 100,000 shares. So that means we have 60%. Okay, so if we go plot this on our timeline, so we have 30th of June 2018. Yeah, the year before that would have then been 30th of June 2017, and on the 1st of January that year, we would have then made our investment in Ben. 1 Jan 2017. Okay. All right, so we know that they give us the equity balances at that date. Now, I know the solution in this particular case, guys, hasn't given you an analysis of equity. So I've just taken it upon myself to put one together for you guys. So this is, I will attach this onto the pacer, but effectively there's our analysis. Okay, just these columns here are all just really calculations to support the numbers of the analysis. Share capital of 1 million, retained earnings of 9.7 million, and a retail surplus of 4.5 million, all directly off the question. All right. And then they tell us that Joe obtained control over Ben as per the definition of IFRS 3, which is great. So we know from this date, 1st Jan 2017, we control Ben, and so therefore we should be consolidating for, I suppose, the 6 months there, the 1 year there, and the 2nd year there. Okay. The details of the consideration is as follows. So we had a cash payment of $9 million on that date. That's cool. And we utilized an overdraft facility that carries interest rates at 21% per annum. So that doesn't necessarily impact us for purposes of this required. Okay. Included in that cash payment was $14,000 relating to lawyers' fees. Okay. So we know what happens with that. Is that must be recorded separately in P&L. So if we look at our consideration calculation, these columns here, we paid 9 million bucks, but included in that 9 million bucks is 14,000 rand. That is lawyers' fees that doesn't belong there. So we strip that out. Okay. And then we made an additional payment that was due on 1 January 2020. Okay. So if we look here, our acquisition date is 1 Jan 2017. So we have to make a payment on 1 Jan 2020, which is effectively 3 years. But because it's in the future, there's a time value of money to that. So we calculate the present value of that. So we said 500,000 in 3 years' time, using an interest rate of 9.44%. That is then going to give you a present value of 381,453. Okay. So that all is all given to us. And then they tell us Joe also then transferred a manufacturing machine to Ben in accordance with the agreement. And Ben will use the machine to produce products used in the manufacturing of inverters much faster and at higher quality. So the carrying amount that Joe would have then given up in this particular transaction is 2 million bucks. All right. So as part of their purchase price, they would have then also transferred equipment of 2 million bucks or machinery, which then gives us a total consideration of 11.36 million. Okay. So you'll see going back to the analysis, 11.36 million is, I've color coded them so you can tie up these numbers. That is then what we've included as part of our total consideration paid when we're calculating our goodwill. Okay. Assets and liabilities were assessed to be at fair value except the following. All right. So other intangible assets on the acquisition date. So I'm just going to keep this in green. A technology patent and a trademark were recognized in their separate financial statements as other assets, but only the trademark was fairly valued. Okay. So which then means we'll probably have work then to do on the technology patent. Okay. The technology patent was registered by Ben on the 1st of July 2016, and the cost at that particular date was 75,000 Rand. Okay? The patent had a remaining useful life of 10 years and a zero residual value. Okay, so guys, remember that that was at the 1st of July 2016, which would have been here somewhere, 6 months before acquisition date. So at acquisition date, the question is, well, what would be the carrying value of that particular patent? Okay, so we have the cost of 750 and 10-year useful life, and we have this for 6 months. That gives us an amortization. And so it says depreciation here. Let me change that to amort. Okay, to get us to 1 January 20, let me just say 1 Jan 2017. That gives us 37,500, which means our carrying amount at that date was 712. Okay. All right, then they tell us that the fair value is 1225. Okay, and from what we know, the useful life and the residual value was not changed. Okay, so we've got the carrying amount at that date. They've given us the fair value. So we will have a fair value adjustment of the difference between the carrying amount and the fair value. That will give us this 512. And we know on that fair value adjustment, it's like a reserve, there will be tax. So the tax on that is 143. So the after-tax figure will be the 512 minus the 143. And we include that as part of our at acquisition date equity, a 369,000 on a patent, on a revaluation of a patent to bring it to fair value. Now, what you guys will remember is that in the case where we've valued an asset up at acquisition date, then obviously after acquisition date, there's the amortization needs to go up as well. So per year, on the historical 750, our amortization would have been 75,000. Okay, but now on the fair value, okay, we have our fair value of 1225. But remember, 6 months would have already passed. And they also tell us that the useful life remains unchanged. Okay, so that means at the 1st of January 2017, we only have, because 6 months have passed, we only have 9.5 years left of this particular asset. So you'll see on this calculation, I've taken the fair value divided by 9.5. So the difference or the additional amortization that we need to then book is 53,974. Okay. Now up to the beginning of the year, just take a step back. So this is our acquisition date. Up to the beginning of the year, we had 6 months plus another year. So that is a year and a half of amortization that we need to account for. So I've just taken that multiplied by a year and a half. Okay, taken out the tax on a year and a half, and that gives you your net. That will then impact your profit since acquisition. And then in your current year, there will be 1 year of additional depreciation that we need to, or amortization that we need to account for. There's the tax and the net as well, which will then see what agrees or ties in with your analysis. Okay. So if we look at this particular patent, ladies and gents, there has been a deferred tax that we've raised on acquisition date of 143. But of that, we would have then realized 22 and 15. So that gives us then a net tax or net deferred tax of 105,753. Now we'll get to that. We'll get to that in a bit. I'm just showing you where these numbers are pulling from. Yeah. Yeah, so that pretty much covers the technology patent. Now we say that the patent is also licensed to a company in Namibia for use in its operations. The terms of the license agreement state that there will be a market annual fee of 125,000 paid on the 31st of December each year until the expiry of the agreement being on the 31st of December 2020. Okay, it's not practical to sell that license agreement separately from the patent. Okay, so what do we see here, guys? If we think back to when we covered intangible assets, remember we said it needs to, for an intangible asset to be recognized, it needs to be separately identifiable and recognizable. Okay, so in this case, you're not able to sell it on its own. So what we're saying is that it's not separately identifiable. So we can't raise the asset in terms of IS 38, okay? But remember, when we look at IFRS 3 then requires us to identify any separately identifiable assets on a group point of view where we don't necessarily look at the recognition criteria, we literally just look at meeting the definition of an asset. So we have a contract in place where we're getting future economic benefits of 125,000 over a certain period of time. Okay, and we control, because we are the only party to that contract, we control those future economic benefits. Okay, so from a group point of view, it would then mean that we have a contract, or if you want to call it an intangible asset, you can, where we get these future economic benefits. Okay, so we have to then give rise to a value on that particular asset. So what I've done here is I've marked it in orange for you guys. So we have a payment of, sorry, let me just make this a little bit user-friendly. We have a payment of 125,000 per year. Remember, we're doing this valuation as at the 1st of January 2017. Okay, so if we just go back to our timeline quickly. Yeah, and we're going to be paying this up until December 2020. So up to December 2017 will be 1 year, December 2018 2 years, 2019 3 years, 2020 4 years. Yeah, so we have 4 years payments per year of 1. So if we calculate the present value, it then gives us an intangible asset of 401,085, and the tax on that would be 28%, 112,304. So your after tax will then be the 288. And remember, this is like a fair value adjustment. We include this at our acquisition date. Okay, so 288,781. But again, in addition to that, guys, we also know that subsequent to this asset, we need to account for the amortization on this particular asset. Okay, so your amortization since, okay, so we divide it by 4, because remember that this contract only lasts for 4 years, and up to the beginning of the current year, 1.5 years have passed. So that's how we get that 150. The deferred tax on that is 28%. Okay, and then of course for the current year, we would then just say divided by 4, and the deferred tax at 28% of that number. So again, the total tax, we would then have a deferred tax liability that we would have raised at the acquisition date, okay, of 1,112. And as you amortize this intangible asset, the deferred tax unwinds. Okay, so you'll then minus the 42 for the amortization for the first year and a half, and then for the second, or from the 1st of January 2019 onwards, or the 1st of July 2018, there's going to be another year. So our net or total tax position at the end of the year will then be the 42,114. Yeah. Okay. Lawsuits. We're nearly there with Ben, guys. Yeah, the information says that a competitor's instituted legal proceedings against Ben. A competitor accused Ben of illegally copying one of its designs, and a claim amounting to 500,000 rand. Now, the dispute arose when an employee of the competitor who left to join Ben was accused of copying unauthorized files of the competitor to Ben. The employee admitted that an encrypted memory, the employee admitted to taking the encrypted memory sticks, but claims that it only contained his personal documents. Okay, so even though it was proven that the memory stick was, it can be proven that the memory stick was taken, Ben's lawyers are of the opinion that there's going to be no compensation awarded in court. And after taking into account all possible outcomes, including the settlement, we would then have a fair value of 400,000 to be placed on this liability at the acquisition date. Okay, so we know that there is a fair value of 400 on this contingent liability. Okay, and so we include that at our to calculate the value of our equity at acquisition date. That's why it's a minus 400. Okay, and due to the highly technical nature of the claim, it was still not finalized. Okay, with the fair value then increasing to 1 million. Okay, so if we see at acquisition date, it was 400,000, and by the end of 30th of June 2019, the fair value increases to 1 million. There will be an adjustment of 600,000 on the claim, okay, where we're going to increase the value of the liability. So this will then reduce our profit. Okay, and then they tell you that the claim will not be deductible for tax purposes should it be successful. So that is why, guys, in terms of our analysis, We've included the straight 400 and we haven't adjusted for any tax on that. Okay. The shareholders have then contractually agreed to reimburse Joe 90% of the losses as a result of the claim. Okay. So now we have an indemnification asset. Okay. So as at acquisition date, we said, okay, the potential loss that we're going to make was 400,000, but we're going to get a reimbursement of 90%. So we have an asset for 360. Okay. So similarly, when the fair value increases to $1 million, the indemnification will also increase then in total to 900,000, which is 90% of the claim, but we've already accounted for 360 of the 900. So we just need to account for another 540,000. Okay. No additional assets and liabilities were identified at this acquisition date. Okay. So guys, now that we have the information in Rob and we've set in Ben, and we've set up an analysis, we know that because we control, okay, we need to journalize the Y effectively. Okay. So, and specifically in this required, they've asked us to only prepare the non-current assets part of the statement of financial position. So if we run through all of these, we will see, okay, based on the non-current assets, okay, there will be a patent reval. There's an intangible that we've raised. Okay, that is a liability. There will be an intangible for reimbursement that we've raised. We will eliminate our investment in the sub. We will raise the goodwill, and then obviously NCI is non-current liability, so that's not required for purposes of this question. And then, of course, guys, there's obviously going to be the deferred tax consequences. Okay, so if we go run through this solution. Okay, so for the first part of the solution, we know what non-current assets looks like. There's PPE, investment properties, goodwill, others, financial assets, and the deferred tax assets. Those are all the things that we'd expect to find in the non-current assets. So what I really want to do right now is I want to take you guys then through the calculations, just focusing on Ben. But before we do that, maybe let's go to the question, because there is an additional part of this question, guys, where they give us the financial information per entity here. Okay, so they've said the table below provides an extract to the relevant trial balances of the respective companies as of 30th of June. And you can assume that the scenario, the information provided in the scenario has correctly been taken into account, except stated otherwise. All balances provided represent their respective amounts. Okay, so we know when we're doing a consolidation, guys, and they've asked for the consolidated statement of financial position, it is 100% H, 100% S. Okay, so right now we've only looked at Ben. We'll come back to the other guys a little bit later, but at this point in time, PPE, 100% H, 100% S. Okay, now these guys, these are generally the easy marks. So PPE, 100% Joe, 100% Ben. Investment property, 100% H, 100% S, 11.5 million. Investment property, 11.5 million. Other intangible assets, 0 plus 856. 856. So you see for each of these there's a half mark, guys. Easy marks. Okay. Financial investments, 29,128 and 0. 29,128. Okay. And then our deferred tax asset, 2365 and 356. 2635, 2365 and 356 all given. And that's pretty much all that we've been given now for Ben. We'll come, like I said, we'll come back to the others in a bit. Okay. The financial investments include both investments in subsidiaries and investments in classified in accordance to IFRS 9. So we know that all the subs investments are included in there, and we're going to need to eliminate those. Okay, also easy marks. And the following amounts were correctly determined for disclosure in the consolidated financial statements of the Joe Group. Okay, so for purposes of Ben, they've given us the NCR opening balance of 8.1 million, and they've also then given us the profit for Ben for the year of 260,000. Okay. So now, guys, we've got all the 100% H, 100% S. All we need to do now is to account for our changes of our fair value adjustments. Okay. So what I'm going to do is, as we work through this, guys, all the transactions with Ben, I'm going to highlight those in green for you guys, just for ease of reference. Okay. So if we look at our goodwill from our calculations, okay, when we journalize the Y, okay, so we said that our share capital, we eliminate the reval surplus. Okay. We do eliminate the patent revaluation, but we know that we needed to bring that asset in. Okay, that asset or that fair value adjustment, we calculated at 5,112 before tax. So what I suggest you could do is that you know that you're going to eliminate the 369, okay? But the contra to that is going to be the asset as well as the deferred tax. So let's go adjust the asset, 512,500. I can just find it. Okay. Okay, so it's 512, but just something that we need to take into account, guys. There is a fair value adjustment, but there's then going to be the amortization that we have as well. So for the period since up to the current year, amortization of 80, and the current year is then 134. So the carrying amount of the assets, or at least the fair value adjustment on the asset at the end of the year, will be your fair value adjustment minus the amortizations, 377,632. 377 in green, 632. Okay. Let's go back to our analysis. Okay. Okay, so that covers the patent. We also then have the intangible asset. Okay, so the intangible asset, we will also then have a value that we raised at the acquisition date minus our total amortizations that we've calculated. That gives us a carrying amount of 154.06. 154.06. Okay. Well, they've got 154.07, close enough, 2.5 marks. Okay. And then, of course, there is the indemnification asset at the end of the year. So if we go back to our analysis, yeah. So we've covered the intangible. There is the contingent, but remember that contingent will sit as a liability that we recognize at acquisition date, not necessarily as a non-current asset. So that's why we won't see it in this solution. And of that, there is a reimbursement. Okay, so we know at the end of the year, the reimbursement was 90% of $1 million. So that's how they get the 900,000 indemnification asset that sits in other intangible assets. Okay, so now that we've accounted for all of those, we know that we need to eliminate our investment and we need to bring in the goodwill. Okay, so if we go look at our investments in equities, there's our cost of our investment in Ben that we need to eliminate from that number. And of course, we need to bring in our goodwill figure, which is here somewhere. Yeah, 18137,785. And then if we carry on with the rest of our Y, the last part is the NCR, but that doesn't impact us per se because it is a liability and they've only asked for the non-current assets. Now, the only additional one, guys, that we still need to account for is, of course, the deferred tax. Okay, so at the end of the year, I've given you guys the totals here at the bottom on how we get these deferred tax numbers. Remember, it will be the deferred tax raised when we created the asset up front, and then some of that asset would have been realized over time. Okay, so the calculations there show you how we get those totals. Okay, so if we go check our solution, lines of Rob, where's the deferred tax? Here we go. All right. Then the deferred tax on the technology payment, patent 1.5, and then as well as the licensing contract 42,114. So we've covered all of those already in our calculations. So I just want to run through the solution quickly and just see that there's nothing that we would have missed for Ben. No. No. Plant of Rob, factory of Rob, Lou. Okay, the goodwill calculation of Ben, you guys can have a look at that, but it's effectively what we've done on our analysis and our consideration paid. We've done that calculation already on the analysis. The future payments, we've done that already on the analysis. The technology payments, how we then get those revaluations, we've covered that already. And then, of course, the deferred tax on that. And same with the licensing agreement and how we calculate the present value there. Yeah. So from part A, from a Ben point of view, everything taken care of. Let's just look then at part B. So let's deal with Ben whilst we're here. Okay. So just to refresh your memory, if we're looking at part B, yeah. Part B specifically said, prepare the statements of change in equity. We only want to change in ownership reserve. We won't have that for Ben because there was no change in ownership. There will be no FCTR. So all there will be for Ben is a non-controlling interest. Now, what they've done in this particular question is that they've already told us in this additional information that the NCR for Ben, the opening NCR was 8.1 million bucks. And the total comprehensive income attributable to NCR is 260. So those numbers are already given to us. So if we just go look on the solution. Okay. Opening balance of NCI. We're just slotting in exactly what they've given us, the 8.1 million bucks. And then, of course, the P&L portion for Ben for the current year, total comprehensive income, OCI, NCR Ben, 260,000 Rand. Okay, so that's just pretty much that for Ben, not much else going on the statement of changes in equity for Ben. Okay, so the major tricks on this particular question, guys, was very IFRS 3, or not this particular question, but just specifically on Ben. It was very IFRS 3 heavy. Okay, so it didn't test much of the consolidation things, but can you apply the principles of IFRS 3 at acquisition date as well as subsequent measurement? Now, in this particular case, guys, in normal circumstances, what you might have done is that you would have gotten the profits or the retained earnings for the period since up to your current as well as in your current year, and you would have calculated your own NCI. But in this particular question, they did tell you, okay, that it is done and it's being correctly done, and they've even bolded it here for you to tell you, don't calculate it. It's not what we want you to do. Just use the numbers that we've given you. All right, so that's where we end the scenario with Ben. Next up, we will be looking at Rob.